So you've heard that depreciation is beneficial to you as a real estate investor, but how does it actually work? In this video, I'm actually going to do a Loom walkthrough, and I'm going to show you step by step how depreciation can impact your tax bill. All right, so in this video, I thought it would be cool to do a walkthrough of an example, because it's one thing to say that depreciation helps you save money, but how does that actually work and what are the mechanics to that? As I go through the example, I'll let you see the impact without and with depreciation and what that does to your tax bill. But I do want to say that taking depreciation is a requirement. So let's just get this out of the way. Like, does your tax return and they're not taking depreciation on your property, unless they have a good reason they should be taking depreciation. There are certain things that cannot be depreciated, like land. It could, if you've had the property for a really long time, then maybe you no longer have a depreciable base, which basically means you can no longer take depreciation. But unless those circumstances apply to you, you should see depreciation on your tax return. So I have my notes here on the side just to make sure that my calculations are on point. So I'll be looking down at my notes and I'll write it on the screen for you to walk you through this example. So let's jump right in. We're going to start with what we're calling our purchase price of our property. And we're going to say that that is $600,000. Now, this property, it's a triplex. So we're able to generate rent, we'll say gross rent for the year of $100,800. We have operating expenses, $55,200, and that leaves us with an NOI, or a net operating income, of $45,600. Now, just to clarify, because I want to show how it's possible for you to cash flow while you are not necessarily paying tax or a lot of tax, right? So I do just want to throw in that we have a mortgage. And so if we have a mortgage, let's just say we're paying like $31,200 on our mortgage. That's principal, because in our operating expenses, we've already accounted for interest. So we'll just put principal here so that we know that this is principal. So that would get us to cash flow. We'll make that a little cleaner. Okay, so we'll say cash flow is $14,400. Okay, so $14,400. There we go. All right, so that is what we're cash flowing, but so that's an aside. So we know that every single year from this property, after everything all out, real estate taxes, management fees, any professional fees, repairs, maintenance, utilities, insurance, mortgage interest, and principal, you are pocketing $14,400. That's what you are taking home. Now let's add in depreciation into this mix. I already said that land is not depreciable, and so in this example, we're going to assume the purchase price is excluding the land. So we're not including that in this example, just so you can understand. But in addition to the purchase price, and I'll just circle that, we also have a couple other assets. So we have our $30,000 of 5-year assets. What are 5-year assets? Those are going to be appliances, etc. When we're talking about real property, rental properties, appliances are normally 7 years, but in a rental property, they tend to be 5 years. And then we have $10,000 of 7-year properties. So this could be cabinetry, this could be furniture, different things like that. That is 7 years. So the last thing we have here is the actual property. So that was $600,000. And since this is residential property, this is depreciated over 27 and a half years. So what does that equate to in expense every year? This now equates to $6,000 per year that we're taking. Then we have, we'll say $1,400. It's a little bit more than that, but we'll say $1,400 just for round numbers. And then for the actual building, we'll round this up just a little bit, and we're going to say it is $21,850. So those are our numbers for depreciation. Now, remember, I said in the video that talked about depreciation and kind of explaining how that worked, that depreciation is a non-cash expense. It is simply the IRS acknowledging that things wear out over time. So this $6,000, this $1,400, this $21,850 is not cash that you have expended in regards to your rental property. But this is where the magic comes in. So remember I said that we have 45/6 of net operating income. So what would happen since we have this depreciation now? We would take that 45/6, and this is our starting number. But then we're going to back out the 6,000. Then we're going to back out the 1,400. Then we're going to back out the 21,850. And so what does that now give us? We are at, that's 20,000, the 7,400, and then we have another 21,850. So now we're at 29. So what does that equate to? Now we have taxable income of 16,350. So we went from taxable income, net operating income of 45,000 now to 16,000. Now, if we put a 30% tax rate on this, well, what does that give us? So if we assume a 30% tax rate, $16,350, that means that our tax is $49.05, so $4,905. Now, let's take it back to the top really quick. Let's take it back to the top, and let's just circumvent. Let's go around all this depreciation just so you can understand what is the impact of depreciation to you dollar for dollar. All right, so then we take this 45,000, and I'm going to put this in red because I want to emphasize this. So we take this 45,000, we're going to do 45,600 by that same tax rate, 30%. This now equates to $13,680. So what is the difference between these two here? Make this a little bit smaller so that you can see. I want to make this clearer. That's 49.05. The difference between these two is $8,775 that you are not paying in tax just by depreciation. I understand we can talk about recapture tax and what does that mean in another video, but this video, I want to show you the power of depreciation and why it's so important to track your expenses and make sure that your accountant, your tax preparer is understanding what you are doing with your properties, because over the life of your time as an investor and over the life of a property, as your portfolio expands, your portfolio grows, this can cost you significantly if it's not done right. I hope you found this helpful. If you want more content like this, please let me know in the comments. If you found this video walkthrough helpful, then I think you will also really enjoy this one. But also, let me know in the comments if you'd like me to do another video walkthrough of another tax strategy so that you can understand how you can apply it to your own situation.